Hey everyone, hope you're doing well. In this video, I want to answer a very important question, especially for us investors, and that is inflation finally under control? And if it is, or when it is, what happens to the stock market? Does it go up or does it go down? That's what I want to talk about in this video, so let's get right into it. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's talk about inflation and let's talk about what happens to the stock market when that finally is under control. So first and foremost, we have to understand that inflation is a twofold problem for the stock market. And that is because inflation usually comes with high interest rates. Now, both of these things can affect the stock market in different ways. So we have to understand that in order to make an inference or a presumption, not an assumption, a presumption about the future in the stock market. So first and foremost, high inflation usually negatively affects the stock market primarily for one main reason, and that is in the inflation that we are experiencing, because there are two types of inflation. There is an inflation that comes with very fast economic growth. That is not necessarily what we are experiencing. We're experiencing an inflation that comes with artificial demand, which comes or stems from quantitative easing, which took place during 2020 and 2021. Basically, the government pumped a lot of money into the economy, which artificially increased demand because there was more dollars floating around. So, in that form of inflation, usually what ends up happening is companies are not raising prices due to demand. A lot of times they are raising prices due to the fact that their own cost of goods sold has gone up due to inflation, which has gone up due to supply chain issues. Now, there is a demand side to this, and that is that there is more dollars in the economy, right? So there is more demand for products artificially. When it comes to the stock market, remember that the stock market is basically just a representation of the companies that are in the economy. So the S&P 500 represents the 500 largest companies in the United States. So inflation hurts these stocks by hurting the companies by lowering the profits, primarily in one of two ways. Either A, because their cost of goods sold has gone up, and they have to put that cost somewhere. So a lot of times they front that cost onto the consumer. B, a lot of times when inflation goes up, consumers restrict spending on non-essential goods to save money for essential goods. So there's a misconception that inflation always causes consumers to spend more money, because if you know that you can buy more today, you're going to spend that money instead of waiting until next year to spend it and be able to buy less. While that is the case, inflation or rampant inflation also causes consumers to be more worried about what they're spending their money on and more cautious. So while a lot of times it does increase good and it can become, increase spending, and it can become a vicious cycle for some goods like essential goods, it also becomes a negative impact on companies that are non-essential. Now here's the thing. In this country, we have a service-based economy, and a lot of the stocks and a lot of the companies that are represented by those stocks are either service-based, finance-based, or tech-based. Now, tech is a big one because for a long period of time, the tech industry has led the stock market. So, in a period of inflation, when other goods are more expensive and other goods are more important for you to be able to live, non-essential goods like luxury electronics a lot of times takes a hit. So when it comes to inflation and the future of the stock market, inflation coming down will benefit non-essential goods. It will also benefit the economy in general because it'll allow people to spend more freely without worrying about having to save money for essential goods. So if we can get inflation under control, that is the first primary positive for the stock market. Now, I also want to answer the secondary thing that affects the stock market, which is interest rates. And then I'll answer the question of whether I believe inflation is finally under control or if we're a long way off. So let's do just that. So when it comes to interest rates, that's the next piece to the puzzle when it comes to the stock market. Now, usually, higher interest rates negatively affect the stock market. Why? For a couple of reasons. One, higher interest rates in essence means that the cost of money is more expensive. Okay, so you have to understand that just like you or I, companies also borrow money. They borrow money in order to be able to fund their ventures. If the cost of money is more expensive, it means that they are not able to fund those ventures, which means that it is more difficult for them to grow. All right. The second main reason why high interest rates, so that's the first one. The first one is if you cannot grow your company, right, the stock market is also going to suffer because the stocks represent companies, and if companies grow, stock prices go up as well. The second one is that when interest rates are higher, usually less risky assets are also returning a higher yield. Now, I'm going to pause, and I do want to touch on the fact that there is some data that shows that the risk premium on risky assets is always more than the risk-free rate. So basically, there is some data that supports the idea that as risk-free yields go up, that means treasury bonds, that means high yield savings accounts, etc. Basically, your return on cash or very safe assets. As that yield goes up, the risk-free premium also increases. There is data that does show that. Here's the thing. When it comes to the average investor, that means the average person, just walking out on the street who is just investing their money, they do not necessarily look at all the data points. So when you have a risk-free return of 4 or 5% like you do in high yield savings accounts, or when bond yields are pushing 5% and are the highest they have been since basically 2007, the average everyday investor is going to look at those rates as a positive thing. And a risk-adverse investor, which most people are risk-adverse at some degree, they're going to look at the two options and they're going to usually funnel money out of the stock market and into bonds, high yield savings accounts, etc., because they can see a perceived higher return on their money. So regardless of whether the data shows that yes, the risk premium above the risk-free rate does tend to remain, the spread tends to remain the same as the risk-free rate increases, you have to understand that the main negative point for interest rates on the stock market is less investment or divestment in the market and investment into alternative assets. I shouldn't use the word alternative assets because that can mean like wine and stuff like that. What I mean is different assets than the stock market, like bonds and like high yield savings accounts, because there is a perceived higher return. So again, coming back to inflation, to interest rates, and to the effect on the stock market, when inflation is finally under control, and I guess that's kind of foreshadowing as to what I believe is going on with inflation right now. When inflation is finally under control, interest rates will follow because the Fed is holding interest rates high to fight inflation. So when inflation reaches the federal target rate, the Federal Reserve's target rate of around 2%, one, less inflation is a positive thing for the stock market. Two, interest rates should follow. So inflation comes down and the Fed will start to tailor their hawkish policies and move to a dovish policy, which means more friendly towards basically not constricting money supply, but growing money supply. In essence, lowering interest rates. Those both will benefit the stock market. So again, we are making presumptions based on data and based on the past and what has happened before. There is no way to tell what is going to happen in the future. And on top of that, there are still some obstacles and some storms ahead of us when it comes to problems in the United States economy, regardless of inflation. But right now, inflation is the hot topic, and it is also the main driver of the problems that we are experiencing. So if inflation comes down and the Fed is able to lower their interest rates, that should be a positive sign for the stock market. And if the stock market can continue to hold its ground, which it has done, it has not taken a crash. It's remained relatively stable. We're not at all-time highs, I understand that, but it has remained relatively stable operating in a high interest rate environment. So if you remove the high interest rate environment and you remove the inflation, which are two negative pressures on the stock market, all else being equal, that should be a positive sign for stocks, for ETFs, and for the stock market in general. Okay, now do I believe that inflation is finally under control? I probably have foreshadowed in this video. I don't believe we're there yet, and the recent inflation data supports that. The most recent inflation report did show that both core inflation and CPI inflation are above the federal target rate. Now, CPI inflation is what you and I feel when we go out and we buy things, which includes food, which includes gas prices and everything else. Core inflation removes volatile assets, usually energy and food prices, which can move on a month-to-month basis more than the other basket of goods. So both of those numbers are above the federal target rate. And until those numbers, the Fed cares more so about core inflation than it does about CPI inflation. Core inflation did come down in the last report, and CPI inflation actually went up. Now, when I look at inflation, it's a balancing act because both are important. And while I understand that energy prices are volatile and food prices can be volatile, those are the prices that we feel the most. So it is something to be taken into account. And they do take it into account. But regardless, both numbers are above the target rate of 2%. So we have a ways to go. And the Fed has signaled that as well. With that said, I do believe that we are on the right track, and high interest rates do seem to be working at curbing inflation. They're also slowing the economy slightly, but they do seem to be working at curbing inflation. So if we continue down the road we're going, the Fed will most likely hold interest rates higher for longer. That means a year out, probably, if not more. But it does seem to be going the right direction. And in about a year's time, inflation should, again, we're making presumptions, but inflation should be much closer to the federal target rate of 2% than it is right now. The thing is, and I've mentioned these in other videos, the Fed doesn't see interest rates falling below around 4%, around 3.9% to 4% until the end of, looking into 2025. So that's something to consider, and we have to understand that we're still a long ways away to having interest rates what we consider low. And I'm not sure if they will ever come down, at least in the near future, to a near zero rate like the Fed has had for the last decade. But any lowering in interest rates is going to help the stock market. Any lowering or as inflation approaches the target rate, that'll also help the stock market. Now remember, we do not want deflation. We don't want prices to go negative, and we also don't want inflation to be near zero. We want inflation to be 1 or 2%. This is a healthy amount. It means that the economy is growing, but it also means people are able to keep up, and wages hopefully will be able to keep up, because that's another topic for another video, which is wages and wage growth, or in reality, wage stagnation in this country. But hopefully this video was helpful. I don't want to make this too long. To wrap this up, inflation is going in the right direction. Interest rates will follow once inflation reaches the federal target rate of 2%. The stock market and the effect on the stock market. One, the stock market seems to be holding strong, even in a high interest rate environment, all else being equal. When inflation comes down and when interest rates come down, all else being equal, that should be a positive sign for the stock market. And I know I've said this twice already, but all else being equal, that should send prices higher. There are still some very real obstacles for the overall economy, wage stagnation being one of those, that we have to really tackle as a nation and as a global economy. But that is topic for another video. All else being equal, both of those things will be a positive for the stock market. And hopefully within a year or so, we will start seeing some of those effects. Other than that, I hope you enjoyed the video. I hope this was informative. I hope it was easy to understand, and I hope it was broken down simply so you could take something from that. If you like personal finance, if you like investing, then you're in the right place. That's all that we talk about here. It's been my passion for over a decade, and I love to be able to share that with you guys. So if you took something from this video, please consider subscribing. It helps the channel tremendously. This is a relatively new YouTube channel, and it is something that I'm passionate about and I want to continue doing for many, many years. So your subscription or your becoming a subscriber definitely helps the channel. And don't forget to turn on the bell notification so you don't miss the next video. Videos are usually on Tuesdays where we break down a topic like this, but I will also sometimes do a video Wednesday, Thursday, or Friday, depending on whether if there's an economic event or if the Fed said something, the Federal Reserve, or if some major change took place or something that needs to be talked about right away. I'll usually do a second or a third video for the week. But other than that, I love you guys. I love this stuff. It's been my passion for a very long time. I love being able to share that with you guys. I hope you have a great rest of your day, and I will see you in the next video.